Next, we have want cutting edge tech, fix the money. And so here with us, I'm excited, is Laura Winter, who is the Downlink, a defense and aerospace report podcast leader, editor. Laura is a friend also. Love the podcast. You all have to go download that on your Apple or wherever. It's really great presentations every week. And let's see, Laura, you've lived and reported from 8 countries, and she just was nominated on the short list for the 2022 Aerospace Media Awards finalist. I believe on your reporting with the Ukraine in space, right? Well, 2023, sorry. Okay, and then so she's leading a panel with George Pullen, who is a chief economist from the Milky Way Economy, Chris Quilty from Quilty Space, and Bruce Cahan from Urban Logic. And I'll let her introduce the panelists further.
I like having stationary microphones. Is this thing on? Okay, I like the up and down look. Ooh, now I can actually hear myself. There you go. Give me one quick second. I see. As you just heard, my name is Laura Winter, and I am a podcaster. I'm a journalist covering space, the space business, and defense. This panel is about fixing the money. It's not about telling space companies what they should already know, like making sure their products actually provide a solution, or that they should diversify their revenue streams, or something akin, to 50% government, 50% commercial, or any approximate balance therein. This is also not about acquisitions or awards, or even really the valley of death. This is a discussion about, as George Pullen, my buddy here, so eloquently put on my podcast, that we have put our cutting edge, bleeding edge commercial space technologies that are needed for space exploration, for commerce, for defense, on a house of cards. And this financial house of cards really came to light with the collapse of SVB Bank, or Silicon Valley Bank. But before we dive in deeper, the way I like to do things is that I don't introduce my guests. I have my guests introduce themselves. And starting with my longtime collaborator and money stuff, and yes, you know who's coming up. Chris, please tell everybody who you are, what you do, and where you do it.
Thanks. My name is Chris Quilty. The company name is Quilty Space. My background, I spent 20 years as a sell-side stock analyst. And for those of you that aren't familiar with the term, sell-side are the guys that you see on the news, raising the target price and downgrading stocks. I did that for 20 years, originally more on the defense side. And then around 2005, I began writing on the space industry. So I did that for about 10, 15 years at Raymond James, left in 2006, brought over my investment banker as my partner. And we've got about a 10-person crew. We're headquartered down in St. Pete. And what we do is we specialize in finance related research, investment banking, and some high level strategy stuff, specifically for the satellite and space industry.
And George.
Hi, everybody.
Wake up, everybody.
It's right after lunch. So my name is George Pullen. I am the chief economist of Milkway Economy. We are a think tank that provides analysis and insights into the space economy. We also are a partnership, so we do write small checks, none of the check sizes that I'm sure any entrepreneur in this room needs, but we do also write checks. In addition, we recently were awarded a CRADA with the Air Force Research Laboratory, which is really cool. And we get to help them with their insights into the space economy through that CRADA. Additionally, my background a little bit is I spent 10 years as a banker, a trader. I've also spent 10 years as a government economist. I have teaching appointments at Franklin Pierce Law School, the #1 IP school in the country, 3 years running now. And I also teach a summer course at Columbia on space economy and space industrialization. Thanks.
And finally, but not least, Bruce.
Hi, thanks for having me. It's great to be on the panel with Chris and George and Laura, which is fantastic. I'm a recovering Wall Street lawyer, Hong Kong merchant banker, geospatial technology finance pioneer for the federal government, 9/11 responder, Ashoka Fellow, and I teach finance and ethics to engineers at Stanford. I teach in both the engineering school and the School of Design, known as the D School, but I also have relations with the Center for Legal Informatics, which we call Codex, which is a joint research center between the law school and the computer science department, as well as the Center for Human Rights and International Justice. That's my Stanford side. I have a nonprofit, Urban Logic, that has done a lot of space research, space economy and finance research. And you'll hear more about that, I'm sure, as we go on.
Fantastic. Here's a fantastic quote from George Pullen, which actually sums up the issue if this clicker works. Ooh, it does. And there's a reason for this. And to get right back, get to the basics of just what happened with Silicon Valley Bank, I would like to turn the floor over to Bruce and George because they lived it. They were in the trenches when Silicon Valley Bank failed on March 10th. Who would like to go first?
Okay.
What happened?
So as the person who lives and breathes Silicon Valley at Stanford, I am a customer of Silicon Valley Bank, and there'll be lots of post-mortems. I think post-mortems are really healthy for the space economy to understand what can go right and what can go wrong. So I don't think we should speed through this. Silicon Valley Bank had created a niche in being a bridge lender to startup companies as they were between venture and other rounds of financing. They were highly embedded in an ecosystem that they were a major part of helping to start and thrive between the venture capital community, the Sequoias, et cetera, and the startup communities in various vectors, space being one of them. When the quantitative tightening occurred at the Federal Reserve, there were about 190 or 11% of US banks exposed to the risk of holding low interest rate bearing treasury securities, which when you hold those to meet a regulatory liquidity requirement as a bank. But those securities, as interest rates started to rise and you're holding low rate securities, become less valuable. Those what was triggered was a couple things. They had gone without a chief risk officer and a CRO for about 8 months, which is not a smart thing to do as a bank. You need someone to keep a laser vision on risk balancing within the bank's portfolio as well as its sources of capital. And they tried to when they finally did hire a new CRO, the decision was made, we need to boost capital. And they went to raise that capital. The market didn't exactly embrace it quickly enough. And so one of a group of their customers, Peter Thiel, as probably the best known, decided over a 6-hour period to reduce deposits at the bank by some 25% in a day.
6 hours.
No bank can sustain a run on the bank such as of that magnitude and stay in business. The FDIC, who insures deposits to 250K, stepped in and had receivership powers, which they exercised to try to keep whatever was in the bank, the assets being primarily loans and cash, intact, so it could be sold. It actually was sold to a pretty family dominated in terms of management for Citizens out of the East Coast.
Let me get George's side. George, you work with a number of companies that are still customers with SVB. How did you even find out that things were going south? I mean, was there at least an email? I mean, was there an alert?
Bloomberg. So the customers, or at least the case of the smaller space companies that I've invested in or advised, found out from Bloomberg. They were watching the news, they saw a headline, and they realized that their banking partner was on the way out. And this has large repercussions for them. Because to simplify the situation, how many people here like the holiday movie, It's a Wonderful Life? Okay, excellent, great movie, okay? So you know what a bank run is, okay? Except now we can just go on our app and do this, and I can transfer it to my other accounts, right? So it's a lot easier. I don't have to go run in, and Mary can't tell George, don't go. And then George passes out all their money for their honeymoon, right? That doesn't happen now, because again, we just swipe it, and we don't care what George says, okay? Good lesson there, don't listen to George. No, so what happened was, not only were they in a situation where their bank was going under, they were in a situation where they weren't sure if they could make payroll. If payroll doesn't sound like a big issue, then you're not familiar with small and medium-sized space startups. Payroll is a big issue, and they're trying to make that on a month-to-month basis. A lot of these companies, you know, with their burn rate and their runway, you're looking at 6 months, maybe 9 months out, and all that's sitting in SVB. And now they don't know if they're going to get that money back. They don't know how they're going to pay these engineers who are working for a firm that's paying them probably about half of what they're worth, because they could just go work for a prime and make 200 a year. So it's not a great situation for anyone to be in. And it was made even worse because even the firms that have investor partners, VCs, angels, and the like, in many cases, the VCs and angels that they reached out to and said, and I was on those calls, hey, you know, we need some help right now. We're an SVB customer. And they said, join the club, we are too. Because SVB wasn't just providing banking services to the people coming out of Techstars and Y Combinator, which are two famous accelerators. They're also the banking partner for many of the VCs. So they had the risk on both sides. And that was a situation that could have gone far worse.
And Chris, how did that affect, you know, how you see the space market? I mean, you deal with investors, you put out reports. I mean, this must kind of shake things up, and not in a good way.
Yeah, absolutely. So the amount of startup activity we've seen in the industry, you know, at its core, fundamentally, it's driven by the lower launch costs, right? When you take down lower launch costs, you can close more business models. And to give you a sense of how much the funding environment has changed, I went back and looked at the numbers. In 2001, there were 3 space companies worldwide funded by venture funding. 2011, anybody want to guess? 11. 2021, 411. So the point I'm trying to make here is that the amount of funding and startup activity that's been bankrolled by venture capital is off the charts. It's unprecedented. And I guess the point I would say is, there's a lot of these companies of different vintage. Some of the earliest and oldest companies like Spire and Planet, they got public, right? They made it through the magic SPAC window and got out the door. But there are hundreds of other companies out there that still have a long way to go in their funding cycle. And specifically, I'll kind of cover tomorrow in a lunch speech, where some of the demand is going to come from in terms of constellations that are getting built. But the point is, I'm going to show you hypotheticals of what the demand or what, how many satellites are going to get launched, but it's contingent on financing. For most of these companies, they've launched initial satellites or a small part of their constellation. And the biggest part of their funding requirements are yet to happen. And so this happened at the exact time where companies are starting to scale up their needs for funding, the sort of growth rounds. And that's where the funding has been hurt the most. More bad news, right? If you're a venture capital general partner and you've got a fund and you've got X number of companies in your portfolio, when times like this hit, what do? Well, what you basically do is you take your portfolio companies and you put them in 3 buckets. The first bucket are companies that are doing fine. These companies look good. They're maybe not generating cash, but they got good cash on the balance sheet. They've got momentum. Just leave them alone. They're fine. The second bucket are companies that you think are worth saving. And so you're going to take all of your remaining capital, and those are the ones that you're going to bankroll to try to get them over the line. And then there's a third bucket where they're gone, right? The funding spigot is shut down. We're going to have to kill the weak ones to save the ones that are worth saving. And so that is going to happen over the next 12, 18 months. You are going to see a flurry of companies announcing that there is not financing and for lack of it. Now, it brings up a good question, which we can probably follow later on in the conversation. If venture capital does not come back, or the space sector doesn't get access in the way that others do. Because remember, things that are new, when these portfolio managers were just rolling in funds, they go off and they make frontier investments in areas like the space industry that they're not as familiar with. And if those bets turn out well, then they want to double down and do more. If they go sour, well, you know what, let's just go back and keep bankrolling SaaS companies, software as a service, good, safe business model. So we don't know what the behavior of the VCs are going to be. If it's older vintage investors like the Founders Fund and Bessemer and RRE and Lux, that have had some good exits, they'll probably be looking to, double down or find some new investments or companies worth saving. But there were, I can't remember the number, a couple hundred first-time investors in the space industry last year. So these venture capitalists had never made an investment in space. They made their first one in 2021. Will they be back at the table? Do they want to expand that portfolio? There's a lot of unknowns going on to the horizon here. And I'll finish just by saying, I think a lot of us have been saying for a long time that there are certain areas of the industry that needed pruning, where there was overinvestment, and this is just a natural part of the cycle. It would have happened one way or another. We don't need 100+ small launch companies. And so that situation had to get resolved some way. This is just the black swan that's going to do it.
But this isn't just launch companies that this affects. I mean, this affects, space companies across the board, whatever they're doing, whether it's cyber, whether it is SaaS for space. This affects everybody. But here's a question, if you know that your bank has failed and it just got rescued by the FDIC, would you actually go back to it?
Yes.
There you go. Exactly. So
No.
why? Okay. Excellent. I love division. Let's hear the reason why, because a lot of space companies have gone back to SVB. And, I've heard some folks saying, well, if they go back to SVB, I just won't, invest in them. So then why are space companies going back?
So I don't know anyone in this room who's a space company who understands the acronym CAMELS. If I use the acronym CAMELS, do you understand what I'm saying? Raise your hand if you do. CAMELS is the Bank of International Settlements acronym for Capital Assets Management, Earnings, Liquidity, and Systemic Risk, or Bank Safety and Soundness. You're not in business to understand whether a bank is safe and sound. Regulators are in business. Counterparties, other banks who have deposits at sister banks, are in business to do that. A bank that's gone through the hazing that SVB has gone through is going to be somewhat hyper vigilant in terms of how they balance their risk portfolio. Now, hopefully, and so far as I've seen as both a customer and a follower and an observer, they have kept intact the lending teams at SVB. They're not going to kill the goose that did lay golden eggs for this bank over its history. First Citizens that bought the bank operations and a few of the other operations from the FDIC is not about to throw down the gauntlet and abandon this sector from anything I've seen. Also, the FDIC, it should be noted, made about $500 million on its taking back as part of the purchase price equity in the bank. So the regulators are not going to want to kill Silicon Valley Bank, or they would have just shut it down and sold the assets. So sold the loan portfolios and put it out of business permanently.
Well, George, why didn't they let Silicon Valley Bank go the way of the dodo?
Well, nobody asked me at the time. So that's probably one of the reasons that they're still alive. No, seriously, I think that if you look at the decisions that were made and you're in the moment, and it's hard now to go back and put yourself back in that moment, but it felt like this could be Lehman again. It felt like that, who's next? What's going to happen Monday? What's going to happen Wednesday? That's what it felt like in the moment.
That was pretty well founded. I mean, a few more banks failed.
Exactly. And so that's why I believe the decisions were made that were made to save the bank. I think this also goes back to the strategy of a space company. You should have, as part of your strategy, experts, either in-house or out, that are helping you make sure that you have solid banking relationships. Depending on your size, that banking relationship can be equally well served by a credit union. It can be equally well served by a smaller bank. If you have larger needs, you might have the need for a regional bank. You might have the need for a too big to fail bank. Remember those banks, the ones we bailed out last time? You might have a need for them and their services. But I want to highlight that it depends on the size of your current business. That's not true for everyone. And there are options out there, particularly for the smaller end of the space companies, ones that may have just come out of incubators and the like, or have just received a few SBIR or STTR awards. They could bank with other banks, and they should look strongly at doing so.
George, you know, when with your companies, when SVB failed and they were unable to access their operating capital, what did they do?
There was some crying, of course. No, but I mean, that's serious. I mean, this is your livelihood. This is your business. There was, let's round up the wagons and call our allies and call our partners. Who can pay a bill earlier? Who funded us in the last round? Who was talking about doing the second round? And maybe they could write us a check today. Who's a friend of a friend who might not give us a rapacious interest rate and float us for 30 days? And those interest rates were not that friendly, by the way, but those were the third call that you'd make on the list.
So why are so many businesses, though, going back to SVB? I mean, my understanding is that this is the only bank that actually really understands what space businesses need. I mean, I understand what you just said, George, that, hey, depending upon your size, you could go to a credit union, you could go to Lehman's, you could go to a variety of different things, but companies still decide to stay with SVB. What is the magic that keeps them there with this one bank?
So this bank made itself a hub of the innovation culture, not just in Silicon Valley by its name, but globally. In Israel, they've got offices many places. They went wherever the VCs were funding startups. And because of the culture of the banker that they had cultivated. And as somebody who teaches, ethical finance and financial engineering at Stanford, you don't get this. This is not the normal banker culture. You walk into a SIFI bank, a Wells or B of A, and you expect to have a coaching conversation about the space industry and what you're building and get understood. That's not that. They haven't groomed a type of banker who not only understands risks of a new industry, but understands the balancing of those risks in terms of dual use, in terms of how to make matches. Because I was a Hong Kong merchant banker, it's very similar in my mind to merchant banking as compared to commercial banking or investment banking. Merchant bankers, it's a little bit old school, but would see in a client what they need and match it to some other client opportunity, and they would be matchmakers in many ways. So SVB was doing that with venture companies. They were also a place that if 95% of venture capital investments fail, then you've got all this talent that has to repurpose itself. They became the job market to place management.
So this makes it so that we have a single point of failure. I mean, as Bucky pointed out this morning, this is a pretty serious problem. It's a problem for our commercial space community. It's a problem for civil space, for exploration, and it's definitely going to be a problem for defense if we can't fund and make sure that these companies can access their capital. This isn't searching for a contract or an award. This is just being able to pay the bills out of the money that you actually have a right to. So, gentlemen, let's talk solutions. I mean, what do we have here? I know, George, you have a solution. Why don't you start off? Chris, maybe you've got some thoughts here. I mean, jump in at will. You do.
Sure. Well, I think one of the things that we need to think about is that when we talk about financial and financial products, what we end up doing most of the time is centering our conversations around equity, and we center our conversations around debt. But anyone in the room who's taken Econ 101 or Finance 101 class, doesn't have to be with me, knows that there are other instrument types that give us financial abilities to do what we need to do as a business. Okay. So we have equity and we have debt. And what else do we have, right? We have insurance products. Okay. We have commodities markets. We have derivatives. So there is a whole landscape of financial products out there, and we are doing the space industry and the space industrial base a disservice, I believe, if we're not giving them access and information to all 5 types. And if the market is not providing solutions for all 5 types, then that's a role that we can swim toward, right? We know they need it. The rest of the industries out there have it, and the space industry needs it as well. The second part of the solution that I would talk about is look at the fantastic model of Pelisys, or In-Q-Tel, if you prefer. In-Q-Tel was started up as a nonprofit VC. That's kind of a joke, of course, because half of VCs are actually nonprofits because they lose money. It's true. They're not masters of the universe. Half of VCs lose money. But Pelisys was set up as a nonprofit VC with a charter, and their charter was to come in and provide financing, to provide investment after the SBIRs, after the STTRs.
Actually, George, who is behind In-Q-Tel? Why is it called In-Q-Tel?
Oh, the Q in In-Q-Tel stands for Q from James Bond.
And so
So-
there was a lot of folks from the intelligence community that actually set up In-Q-Tel because they saw
Correct,
the
correct.
value in the technology being developed and they didn't want it to go under.
Right. So in the late,
And be
so in the late
lost.
90s, and that's when I got my start trading. In the late 90s, you could make money if you picked any .com, and it was a great time to be a trader. And you could make money on anything with this .com, but that there was also a wealth of intelligence technology being developed at that time. And the intelligence community said, you know what? We need to make sure that we're keeping up with this technology, and we need to make sure that the technology that we need is coming out of this powerful economic engine. I believe we are in a similar situation now when it comes to space. There is a wealth of technologies being created. There is a system in place that provides financing, which I agree is probably going to go through a little bit of a rough patch here, as Chris had said. But for us to access that, you need a lead. Many of the investments that followed behind In-Q-Tel's money, and they have great reports on this. Okay, for every dollar that they put in, there's anywhere from a 5-to-1 to a 20-to-1 that followed because of the partnerships they built with other investors, and they were able to use as a signaling mechanism that says, this is technology that's gone through the ringer. It's run its laps. We've invested in it, and we want you to invest in it too. Family office, VC, etc. So I believe a similar structured organism would do a great deal of good for the space industrial base.
Chris?
So I don't have answers per se, but I guess I just want to say with regard to this topic, I mean, for most of you here, you've never used Silicon Valley Bank. You may not even have known of it before. And it's pretty easy to feel a lot of, Schadenfreude when these turtleneck wearing, LL Bean or whatever with their vest, they're having a tough time, right? I kind of laugh. And, the reality is, though, as much as you may want to hate on the venture community, and there's reasons that you might want to, the reality is it's a very important growth engine for the United States. And it is a massive set apart from what happens in the rest of the world. And it gives us an advantage in terms of our technology development. If you look at, China, it's all top down, right? They're saying you will spend money on this area, you will spend money on that area. Even in Europe, which realizes that they just don't have the venture community or the risk tolerance that we have in Silicon Valley, their solution to it was, we're going to create $1 billion government venture capital fund. Ha ha ha, that's like an oxymoron. Those are political decisions that are being made about who's going to be funded. So I think my concern, and just what I would convey, to everybody to think about here, is it is important, right? If the government looks at this and says, you know what, we're going to punish everybody that was associated with this, the executives in Silicon Valley Bank, and, oh, you sucker that bought them, right? Now we're going to do to you what we did to Bank of America after they bought Countrywide in the crisis, right? And we're going to extract billions of dollars out of you. If that situation happens again, it will severely damage the venture environment here, the community, and I would argue one of our competitive strengths that we have, relative to adversaries around the world or just near peer competitors.
Bruce.
So Laura, just test. So I have a couple of solutions, but I want to pick up on a thread that George started, which is, every entrepreneurial endeavor goes through an arc of maturity. And at the beginning, you're not that good a storyteller, to be honest. You got great slides, but not that great of story. And as you move along, you move through different readiness levels, TRL, manufacturing readiness, you got a business model, BRL. I've done research with Sean Ross at AFRL on this. So we need a Rubik's Cube of money that you can talk your story to at each RL that you achieve, because there's only, like Austin Powers, certain flavors of money, a family office, perhaps, an angel, that want to hear the story you are legitimately able to tell at a point in time. The two solutions that I've been championing, as this group knows, are the Space Commodities Exchange, which will then let us see where supply and demand for specific commodities meet. So we don't have too much launch, we don't have too much imagery, et cetera, et cetera. We can talk a lot about that. And the other are space bonds. So government-backed, in the sense of tax exempt flavors of bonds that every other critical infrastructure, health, transport has, education has. If this industry is critical, then it ought to have, again, where George and I see totally eye to eye. Let's be competitive in the flavors of money that we've evolved for these other critical infrastructure industries. And that will be our competitive advantage vis-a-vis the peer competitors, right? And we would want people who have great ideas abroad and adhere to our systems of belief for democratizing space to come here and get financed here. That would be a nice thing, because then our law governs the bankruptcy and the treatment of the IP and some of the other things that come with financing startups and maturing industries.
Anything else to add, gentlemen? No? Questions, thoughts, answers, or is Casey gonna kick us off the stage?
I'm gonna kick you.
She's gonna kick us off. All right. Oh,
All
here
right,
we
yeah.
go. Now I feel.
So great review of what happened, but the theme of the conference is building enduring advantages. So each one of you, what's the outlook going forward? Because we have to compete globally. China, with their centrally managed economy mentioned earlier, is full game on. So we can vilify the canary in the coal mine, but last I checked, I just looked online, the banking industry is still a very shaky situation. So what do you recommend that we explore as an input for the report?
Rock, scissors, paper,
So,
gentlemen.
sure.
Yeah. Go.
Look, Bucky, I think knowing supply and demand statistics, not only for Leo, but the other places we want to go to, that is a signal to investors that it's safe to invest in whatever those particular commodities might be. We hear about debris as a commodity, obviously refueling as a commodity, as General Olson talked about. So if you don't have the benefits of our system of transparency, you're left with the opaqueness of China's. And we've not made transparency of our market. Yes, Quilty does an amazing job. Bryce does an amazing job of trying to give us transparency. But that's not exactly the same as registered commodities contracts that are enforceable on a marketplace. A commodity can also include derivatives, as George was saying, that transfer risk. Will the launch happen or not? That adds insurability to this industry and sustainment, so that you don't have to lose all that equity in that company by self-insuring against that risk.
My recommendations would be that we fully activate all 5 types of financial products and instruments that we have at our disposal as the biggest and best free market in the world. And that we make sure that the space industry has access to that, which means that in addition to talking about SDA and SAA, I think we need to talk about SEA, space economy awareness. We have a lot of people who are brilliant technologists, but they do not understand the way the economics works or the finance works. And that is a shame, but we could fix it.
I think the OSD needs to give you a bigger budget, Bucky.
Right on.
Do you have any specific thoughts about, the Defense Production Act Title III arrangements to address some of this being rolled out by Congress and the president?
So I'll jump on that one. I think there's a time and the place for the Defense Production Act. I think that that time and the place has to be after something has been defined as critical and the needs are there, and we already have a good standard for what that looks like when that's been used before. I think we have other tools in our chest that we can access before that.
George, just to follow on that, are you saying that if space infrastructure was designated as a critical infrastructure along with the other 16, like power and the financial markets and healthcare, et cetera, that would make that time come forth, that we would then be able to access the Defense Production Act?
When we have the fire drill moment, that will be what happens anyway. Why don't we just do it now and designate it critical now ahead of time, right? We could do something ahead of time. And then if we needed to activate it, it's there.
One thing that's clear from the COVID experience we've all lived through is it takes a little bit of time for the private industry to respond to a crisis if its supply chains and all the rest have not been matured to be responsive to that urgency. So you really want to think, even if, as George says, you don't want to have an emergency, but you want to drill for an industrial base that can be as responsive as the emergency that you might have would require, such as being denied some use of stuff because you've given it all to the Ukraine to fight the Russians. So I think it's a mindset we could adopt, and that would lead to, again, something that George and I agree on, which is I've suggested we need a center for space finance, insurance, and market formation. I'd love it at Stanford, but George, it can be wherever you want. Let it be there, because you have to teach people how to think about financial engineering with all of our tools in the tool belt for space. You can't just do one at a time, or this kind of, we have a new acronym of a new office that's being set up, and it's like mind-numbing. That's not what an emergency requires.
Very specifically, there are people in this room who have to do propulsion testing, who have to do radiation hardening testing. And we all know there's only a few places you can go. And the reason there's only a few places you can go is because they're expensive. And how have they been built to date? Well, they've been built by a prime, or they've been built by a university. That's about it. If we had bonds, space bonds, that would be an opportunity for someone to say, you know what, this makes sense. I can borrow this money, pay it back. I'll have investors who are interested because they get the tax breaks of having the space bond. And then they have a commercial enterprise of providing additional facilities that can test for propulsion, advanced propulsion systems, advanced radiation hardening systems. Again, there's a bottleneck right now. You can free it up with other financial tools that we already know how to use in every other industry.
We talk a lot about matching the form of capital to the maturity of the asset. Okay, real estate is a classic example where there's mismatches all day long. We need that in space. If space is infrastructure, as Laura postulates, then we need long-lived financing, which venture capital and angel is not. So let's get our Rubik's Cube of money sorted out here.
I have one little comment to go off of what you said, Bruce. You know, we all went through the pandemic, and the pandemic is kind of a once in a multi-generational sort of experience, right? I mean, the last real pandemic that we can think of was, well, the SSIB crisis, before that, Spanish flu. We know that there are going to be a number of banks this year and the next year that are going to fail. This happens more often than a pandemic. So why are we, me as a journalist, I ask, why are we not putting in some sort of structure, something that makes it possible for space businesses, for those technologies that our defense relies on, to be able to continue working through whatever the fragility or upsets or stresses that the financial market might be going through, that they should actually be somehow cushioned from some of this, especially when it's not their fault. Any more questions? No.